June 5th, 2024. We got a gap up today and then a pullback to the moving average, and it ended up being a wedge. A wedge to the moving average is a pretty common pattern at the start of the day. A lot of times, if you get a bull trend day, it does start with a pullback to the moving average or something like that. And today was a pretty classic example of a small pullback bull trend day. The target ended up being the all-time high, which was around right here, which, as you can see, was where a lot of traders exited, and then we started to go sideways for the remainder of the day. Bar one, we had a big gap up and then a bear bar closing somewhat near its low. For the bulls, they got the big gap up, which is essentially just a big bull bar, and then disappointing follow through on bar one. So bulls are hoping it's a high one and that we're going to trade above it and start to rally, but it's not all that likely. Most likely, we're going to get back to yesterday's high because it's a magnet. And one of the reasons it's a magnet is that the prior day's high is the high one, right? So June 4th was a high one buy, an inside bar on the daily chart. And whenever, you get the gap up far above a high one or a gap down far below a low one, you are probably going to retest the entry price of that high one, since the traders who shorted that high and expected the market to pull back to it are most likely going to make money as well. So whenever you get a high one or a low one on the daily chart and then a gap, you should be expecting a test of that prior day's high. Bar two, it's follow through for the bears. It's consecutive bull bars. So bear bar one, bear bar two. Are we always in short? I don't know. The gap up was pretty large. So I think it's hard to say that we're always in short after bar two. So a lot of traders, what do they think? Well, they think we probably need, excuse me. They think we probably need one more bar in order to claim the market as always in short. So whenever you're sitting there thinking, well, we might be always in short, but we probably need one more bar, the reality is you're probably not going to get that one more bar. And more likely, you're going to end up getting a bar in the opposite direction. So some limit order bulls, they see bar one and bar two, but they know that the gap up is pretty strong. So they would, the bull argument for buying the close of bar two would be that we're not quite always in short and the bears need one more bar. So they're probably not going to get it. And that's why you get bar three. Bar three, an inside bar, a high one. It's okay for the bulls. They're betting gap up, pullback, and then bar three. Basically, if you're buying above three, you're hoping that it's the high of the day, or we've seen the low of the day. What are the odds that bar three is the low of the day? I thought probably like 30%. So, whenever you get bar one, so bar one on any given day has a 20% chance of being the high or the low of the day once it forms. And I thought looking at bar three that the odds, because we're a couple bars later, potential bear trap 1, 2, and a reversal up. That does happen sometimes where you get a big, consecutive bear bars on the open, and then the market traps those traders and reverses up. But today would be a failed example of that pattern. I'm going to try and find an example. I'm going to pause this for a second. I couldn't find any examples. I do have a folder on it, but it's probably just buried somewhere. But anyways, bar three, I would say 1 in 3 chance that bar three ends up being the low of the day, and 1 in 3 meaning it's low probability. So probably what's going to happen is you're going to be disappointed if you buy above bar three. And that's exactly what happens on bar four. So bar four, a bear bar closing near its low. Do you sell below 4? I probably wouldn't, because if you're selling below 4, well, you have to be aware of the fact that we're probably going to get back to the 3 high since it was a reasonable stop order entry. Some traders buy above 3 and they're scaling in lower using any sort of bounce to get out at break even, which is around where the 6 high was, which is one of the reasons why we started to sell off when we reached that 6 high. But anyways, bar 4, a bear bar closing near its low. Bears argue bear trend 1, 2, and then disappointment 3, but low 1 short bar 4. But we're not quite always in short still, I don't think. I think bears need, one more good bar to make us always in short, which is, again, why they probably will not get it. We get a doji bar on bar 5. Not really all that great. Bulls see a high 2 on the open. So when you get a high 2 on the open, reasonable chance that it's the low of the day. But instead of a bull bar closing near its high, we have a bear doji bar. So do you really want to buy above a bear doji bar? I probably would not. So again, looks like we're going to end up being more sideways here. Bar 6, a bull bar closing near its high. It's an inside bar, and it's good for the bulls because it does not trade above 5. If it had traded above 5, it would still be the high 2 buy above 5, and we would have a bear bar as the signal bar. Instead, we have an inside bar on 6. So bar 6 is the signal bar for the high 2, which is a bull bar closing near its high. So an increased chance that that is the low of the day, rather than if we had traded above bar 5. Bar 7, a huge tail on the bottom. We've done this a couple times this week, so bar 7 is often important, and we make a big move on bar 7. You can see we had a big move, bar 7, a big move, bar 7, big move, bar 7. So it's a little bit dangerous sometimes, especially when all week we've been getting big moves on bar 7. I wouldn't even be surprised if we got a big move on bar 7 tomorrow. And if we don't get a big move on bar 7 tomorrow, I'm sure we might end up getting one on Friday. But the market kind of gets in moods, and sometimes there's news events at 10 a.m. Eastern Standard Time or bar 7, and it causes big moves. But I don't know if there's news events on any of these days, but I just know that on bar 7 you have to be careful because the market can move a whole lot. Bar 8, a bear bar closing near its low. Do you sell bar 8? I would not. You're selling a third push down, 2, 5, and then 7. So that's possibly a wedge. And if you're selling 8, your risk is huge, and you're probably towards the bottom of a developing trading range. Think about it. Why did bar 3 close on, close relatively strong? And why did bar 6 close relatively strong? So if bar 3 was a reasonable buy and we haven't gotten back to the entry price, that should bother you. And bar 6 closed on its high, which should also bother you if you're a bear. And if you're selling 8, you're selling an inside bar, but you're selling at a spot right where a bunch of other bulls bought, or bears bought back shorts during 7. So I would personally wait to see if 9 is a follow-through bar for the bears. If it is, then you can look to sell. Just my big issue with it is you're selling looking for a bear trend day. You can't be selling looking for a bear trend day or a trading range, because if it's a trading range, this is probably towards the bottom of the trading range. So selling down here, it doesn't make quite as much sense. A reversal up on bar 9. Do you buy above 9? I think you definitely can buy above 9. I did not, because like I said, I think I mentioned this, but I do not buy above bull bars that do not close on their highs. So I only buy above bull bars closing near their highs, and I'm only willing to sell on bear bars closing near their lows. I'm probably more of a rule-based trader than a discretionary trader, because you have to be for a while. 10, follow through for the bulls, but there's a tail on the top. So we have a tail on 9 and a tail on 10. And is 10 follow through for the bulls? Yes, but if you bought above 9, you're at a loss. So even though 10 is follow through for the bulls, it's probably not quite as good as it could be. However, if you're buying above 9, again, wedge, one logical reason to do so is that you think we're going to get back to the bar 3 high, and that you think if we go down, you'll be able to buy more a bit lower, and you're still going to make money. So you end up getting the huge follow-through bar on 11 to around the bar 3 high, which is good for the bulls. So now all the bulls have been let out of their longs. The bulls who bought, maybe scaled in lower or just took the buy down here, have all been let out. You can see around the 3 high. Do you buy the close of 11? You probably can, but there's a lot of issues with it. This channel down was relatively tight. There's a big tail on the top. And, we've had tails 9, 10, 11. You're at the top of this buy climax, 7, 8. Like I said, can you do it? Yeah, it's 3 straight bull bars with at least one of them closing somewhat near its high. They're all closing above their midpoints. So we are always in long. And you probably can, 11 flips the market to always in long. So that's one reason you can take that kind of trade when the market clearly flips. But the thing is, if you take a trade where the market is flipping to always in long, you're risking a trading range, because in trading ranges, you don't want to be buying right as the market flips to always in long, because that's usually the top of the trading range. And in trading ranges, you don't want to be selling as the market flips to always in short, like here, because trading range. So that's right when the market reverses. So if you're buying the close of 12, you're betting it's going to be a bull trend day. And you were right today if you did that. So if you bought the close of bar 12 or bar 11, your premise was this is a bull trend day and we're going to continue higher. And I think if you buy 11 and 12 is a bear bar, then you just get out. But the traders buying the close of 11 are hoping this is going to be a big bull trend day. They know that, it probably won't be, but they're expecting to hopefully at least get something out of it. And that, bar 12 is not going to be a huge bear bar, even if it is a bear bar. Bar 12, follow through for the bulls. So good for the bulls. We have 4 straight bull bars, none of them quite closing on their highs, but it is okay to be long. And then you get really surprisingly good follow through on 13. But the problem with buying above 13 is this is now very climactic. we'd already gone up pretty far on bars 9 through 12, and now bar 13 is a big bull bar closing somewhat near its high. So if you're buying up here, to me, I think this just looks, you're going to have to sit through a pullback. So you can't really buy above 13 and then exit below 15. I think that's kind of counterproductive. I think if you buy above 13, there are two ways to manage it. You see 14, a doji bar. If you're buying above 13, you're kind of hoping for a quick scalp. You know that you're probably not going to, get it. We're probably going to have to pull back. I would say 60% chance. But if you're buying above 13, you're hoping, I don't know, maybe 14 will also be a big bull bar and I can make 5-10 points and then just exit the trade. Or you buying above 14 with a stop below 9, really wide stop, 13 with a really wide stop. And you're thinking, okay, we're going to pull back here, but even if we do, I think that the overall premise that the bulls are a lot stronger than the bears and we're going to get a measured move up is a valid premise. So you can do either one of those things. I think if you buy looking for the scalp and you see 14, while it is follow through for the bulls who bought the close of 13, it's not good follow through. And when you're in a buy the close rally, like we are, 9 through 13, and then you get a doji in the buy the close rally, that increases the chances that the buy the close is likely going to come to an end and you're going to start a channel instead of a bull trend. So what happens is the traders who bought above 13 are disappointed in 14. You can see we rallied a tick or two above 13 during 15, and that's where we ended up finding sellers. And the reasoning for that is the bulls who bought, they saw 14, they were disappointed. It's still a follow through, but they were still disappointed, and they used the mark. They exited on 15, and 15, a bear bar. Do you ever sell 15? No. It's potentially a micro double top with the tail on 13, but it's not a great argument. So I think that probably more buyers below 15. And I would, if I had bought above 13, I did not, because I was not confident in my ability, which is okay, by the way, to not be confident in this certain ability. It's recognizing the things you're not as good at is really, really important. So I did not take the buy because I would probably have to be somebody who is going to be trying to scalp out of that trade rather quickly, and I'm not that confident in my ability to do that. And sometimes it's difficult to sit through pullbacks. And I thought if this was a trading range, we could get kind of a deep pullback. So I just decided not to buy above 13. But if you do buy above 13, you can just sit with the premise that the first reversal down should fail, but should fail doesn't mean it's going to. So this time, I think if 16, if you stay in the trade and 16 is a bear bar, you just get out. But you can see we do already have an open gap with the 10 high and the 12 low, and 16 a reversal up. And really important here that 12 and 16 do not overlap. So I thought that was really important. And we now have two open gaps for the bulls. So as long as this gap stays open, we have two open gaps, and we could still be in the early stages of a bull trend day. 17, a bull bar, but a tail on the top. It's an inside bar, so it's a high one buy for the bulls in their bull trend. It's okay to buy, but it's okay to also wait for a higher probability trade. 18, a doji bar. It triggers the buy above 17 and then turns into a doji bar. But again, the doji bar is still technically follow through for the bulls. It's not good, but it is still follow through. 19, a huge bull bar closing near its high. It looks really climactic, but you can buy it. And then 20, a bear bar closing near its low. I think any bull, regardless of the open gaps, is going to get out if we trade below 20. And so what do some bulls do? They buy the close of 20, put a stop below 20. And on this time, those bulls won. And something really interesting, if you had bought above 19 and you see 20, how do you feel? You're probably disappointed. You're a little bit upset. You wanted to see a good bull bar on 20, and you thought, well, I thought this was going to be a bull trend day, but maybe not. And then you get 21. And what 21 shows me is that the bulls who bought above 19, even after 20, when 21 got back to their entry price, they didn't think, oh, thank God I'm able to get out of this trade without a loss. They instead thought, no, my premise is correct. My premise is still valid. We can still go higher here. And they bought more. And that's why 21 was able to be so big and close on its high. So 21 really important, and it shows the confidence in the bulls to continue to buy. We additionally have an open gap here, which is really important. So we have open body gap here. 22, some follow through. 21 is still a big bar with big risk. So while it's an okay buy, we're probably going to have to start to pull back at some point here. 22, follow through for the bulls, but a bull bar with a big tail, so not quite ideal. This is what happens on small pullback bull trend days is you never end up getting the ideal follow through. you always get just enough, just enough to follow through for the market to not reverse. But the key to small pullback bull trend days is the early open gaps, because the market often looks like it just spends all day looking like it's going to reverse, and it just never does. And so it doesn't necessarily trap you into selling. Well, I mean, I'm sure, I don't sell small pullback bull trend days anymore, but I definitely have in the past. But it doesn't necessarily trap. Well, the thing about small pullback bull trend days. So I'll just go on this little tangent. This is kind of how it works with all of trading. Is in the beginning, when you're trying to trade, you're going to end up just selling this all the way up, and you're going to lose a pile of money. You're probably going to take all the reversals down, and you're just going to lose a bucket of money. And then eventually, you'll start to realize that, okay, I shouldn't be selling here. I shouldn't be selling. I shouldn't be selling. I shouldn't be selling. And you'll watch the whole day go, and you won't make any money, but you at least won't lose any money. And then eventually after that, you'll start taking one or two entries, and you'll make a little bit of money. And then eventually you'll get even better and start taking all of the entries. So it's a process like anything else, where it goes from, losing money to losing less money to losing no money to starting to make money and then make a lot of money. So it's that way with trading range days and everything like that too. The beginning of trading range days, you buy all the tops, you sell all the bottoms, you're really disappointed with yourself and upset. And then as you get better, you slowly stop taking the trades that are at the tops and the bottoms. Like you stop selling the big bear bars near the bottom, you stop buying the big bull bars near the top, and you start, just looking for the small bars to buy near the bottom and the small bars to sell near the top. But it just takes a lot of time. So anyways, 23, a bear doji bar, not good for the bulls because it's not follow through, and you're buying relatively high. We could be forming some sort of wedge, 1, 2, 3, or 1, 2, 3, but it's pretty parabolic either way. So if it is a wedge, it's going to be a minor reversal. We trade below 23, but no one wants to sell below 23. It's doji bar, probably buyers below, and a bull doji bar 24. Or sorry, a bear doji bar 24. It's a high one buy for the bulls, but I don't really want to buy above a doji bear bar. So not really all that great. You can see it triggers on 25, but not much enthusiasm. We continue to the upside on 26, but the tail on the top, so not as good as it could be. And we go up a little bit more on 27, but again, the tail on the top, it's not as good as it could be. Something that's interesting here is 20 was probably a credible sell if we traded below it, since bulls would exit. So whenever you have a credible sell in what's going to be a developing trading range, instead of selling below it, some traders will just try to sell above it, thinking we're going to get back to this entry price. And instead, the traders who even didn't forget selling below it, the traders who sold above it are trapped, right? So if you sold above this and tried to scale in and get back to the 20 high, that was probably a logical thing to do. And those traders are still trapped after 24, 25, 26, 27. So those traders are thinking, well, this might be a small pullback bull trend day. And I think the real hint of the day was, are we going to get a pullback for the bears? Well, everyone is expecting a pullback at this point, but I guess the thing was, are we going to get back to this 20 high, or are we going to start to rally again before we do? Because if we start to rally again before we do, the odds have dramatically increased that this is going to be a small pullback bull trend day. 28, I think reasonable for bulls to exit their longs. I don't think it's reasonable to be selling anywhere today, pretty much. But some traders, Al will always mark sells somewhere up in here, but I think if you're looking for sells on this kind of day, you're missing the point. So bear bar 28, I think bulls make sense to just get out. It could be some sort of wedge. We have a spike 9 through 13 and a wedge channel 14, maybe 22, 27, however you want to look at it. You can see it's probably a wedge channel. So a lot of traders looking to get out, I think below 28, and expect a couple of legs sideways down at least before we start to rally again. 29, follow through for the bears, but really a big tail, not all that good. A doji bar on 30, again, really not all that ideal. 31, a reversal up, but it's a high one after 3 bear bars, and we're pretty overbought here. So I think we're probably going to get at least a second leg sideways to down. So probably not many buyers above 31. You can see, like I said, on the daily chart, when you think about high ones, probably going to lead to a deeper correction before we continue to rally. So you have to expect that we're going to go a little bit more down before we start to go up again. 33, an outside down bar. It's 2 legs sideways to down. You can see, so 28 to 30, and then pull back 31, and then 32, 33. 34, a doji bar. It's a high 2 for the bull, or you could argue, well, so if you want to be technical about it, you have to wait until the bar trades above another bar. So technically 32 would end up being the high 1, and 34 would end up being the high 2, but I just look at 31 as the high 1 and 34 as the high 2. So I don't, either way, it's a high 2. I don't think it matters which way you look at it, but regardless, 34, high 2. I would not buy above 34. It's a doji bar. I would wait till you see a bull bar closing near its high. And then you get a bull bar closing near its high at 35, and the gap between the 20 high and 24 low is still open. So very reasonable to be long here. Doji bar 36, not great follow through, but still okay to be long. Follow through for the bulls 37. We got past the 27 close. So if you bought the close of 27, those traders scaled in lower and they did not exit their longs when we retested the close of 27 during 37. They bought more because you could see we closed above it. One of the reasons is probably that the 20 high and the 24 low do not overlap. 38, more follow through for the bulls, but a big tail. Again, at this point, I'm looking at the all-time high, which was 58.25. So I was looking here, and I was, any trade I was taking in here, I was basing my risk reward off of a trade up to this point, because this is where I was expecting traders to start to take profits. And just because, when you're in a small pullback bull trend day, just try to look for an important magnet on some time frame and trade based on, the market hitting that magnet. And oftentimes it'll hit a much more ridiculous magnet than you think it's going to. No one was really all that convinced we were getting to the all-time high when we were down here, but as we get closer and closer, traders get more and more convinced. 39, a doji bar, but still a bull bar, and you can see we traded below it on 40 and got the reversal up, so outside up for the bulls. Essentially a high 1. I don't really want to buy though. You can buy, but your risk is relatively big. We might have to go a little bit more sideways before we get to the all-time high. 41, follow through for the bulls, but a tail on top. And you can see a bear bar 42, but after this many straight bull bars, bulls are going to buy below 42. And that's why we get the outside up bar 43. 43 was attempting to close on its high for a lot of the bar. And if it did, a lot of traders would just take the buy, and it's a reasonable swing trade hoping we get here. But instead, you get a disappointing follow-through bar on 43. So bulls are waiting for a big bull bar closing near its high that they can buy for a swing up to the all-time high. And bears are waiting, to see if we get basically wait for the bulls to give up. 44, follow through for the bulls, but a doji, the bulls are not doing enough. And another follow through bar on 45 for the bulls. Again, it's okay to be long, but you have to keep in mind, it's relatively risky. You're hoping we got the exact opposite of a bar like 46. You're hoping we got 46 to the upside, because the moment you get a bull bar closing near its high, bulls are going to start buying, thinking we're going to the all-time high. And instead, you get 46, bulls give up, bar closing near its low. But bad follow through on 47. Bears need at least 3 bear bars to convince traders that we're always in short. And the market's been so strong all day that's probably not going to happen. So instead, disappointing bar 47, and then a surprisingly strong bull bar 48. And the market will often do this when it's going to go to magnets, is it'll try to trap you out. It tries to trap you out with 46, and it tries to trap you out with 57. And if when you get a surprisingly good bull bar right after it, like 48 closing on its high, it's a big bull surprise. You just have to buy again. That 46 and 47 were strong enough we might get a second leg. And you can see 51 tried to trade just below the 47 high. It only got to the 47 high. It didn't trade below it, which makes it a little bit less bearish, because some traders are still trapped. But regardless, reasonable swing buy above 48. Follow through 49, good for the bulls. It's just not a very big bar. And again, follow through 50. It's still good for the bulls, but these bars just aren't very big. Outside bar 51, but a tail on the bottom and top. It is a bear bar, so it could be leg 1, 48, 59, 50, pause 51, and then leg 2. 51 failed breakout above the high of the day, so we might start to go more sideways soon. But we still haven't had a close below the moving average in quite some time. Bulls bought the EMA pretty aggressively when we tested it on 47 and 48. 52, an inside bar, a high 1. It's an IOI. 50, 51, 52. Again, target high of the all-time high. Follow through 53, 54. So, but still by the close bars, we're getting relatively close. Again, we should get there at this point. I'm very convinced. I would say I was 70% convinced that we were going to get to the all-time high once I saw 53, 54. Then a doji bar 55. So concerning for the bulls, right? If you're buying up here, you want to see a vacuum test. You're hoping everybody's going to start piling in, and we're just going to get a vacuum test to the all-time high, and then you can exit. Kind of like what we got 60, 61. But instead, you get a doji bar 55, and then a bear bar 56. So traders are disappointed that we got even any bar to trade below 55. It's pretty unlikely that that would happen if we were going to continue higher immediately, because 56 not a very good buy above for like a 5-point scalp, which is what you need to get to the high, and it's a high one, so traders probably more likely to buy below it than above it. 57, a bear bar closing near its low. I think it's okay to exit longs below 57 and just look to buy again above a bull bar. So if you do exit below 57, you just buy again above 58. A bull bar closing near its high. 59, a doji bar. It's follow through since it's a bull bar, a non-bear bar, but it's still closing just below your entry price, so it's not all that great. You want to get a vacuum test up to the moving average pretty quickly here, and then we get it. 60, a bull bar closing near its high, and you can buy above 60, trying to make a 2 or a 3-point scalp to the all-time high, and those traders were able to do that on 61. Doji bar 62, showing a lack of follow through, and what I think it shows is that this was the test of the high that the bulls wanted, and now we're probably going to start to go sideways. 64 or 63 follow through for the bulls, but I'm not really willing to buy anymore. I think that we're going to end up going a lot more sideways here, and I'd rather be looking to take profits in this area than to buy anything. So 64, bear bar closing near its low. Bulls will exit if we trade below it, and you can see a lot of traders bought it, and we were not able to trade below it. That caused 65. And then sellers above 65, because again, the bull trend is over. It's not technically over, but the targets have been hit. So I don't know how much higher we're really going to go here. 67, an outside bar, and then 68, another inside bar. So IOI, theoretically a buy above 68, breakout mode, but not really good. I think it's way too late in the day to be doing that. And then bull bar closing near its high, 69. Again, in theory, it's by the close, but I think the target for the bulls was over here, and that this is all a final flag. And you can see we got a failed breakout above 67 during 70, and then a reversal down. I probably would not buy 73. It's a minor reversal after 71, 72, and then sideways for the rest of the day, and then huge bull surprise on 77, 78. 77, 78 is strong enough. We're going to get a second leg sideways up from it tomorrow. But you also have to keep in mind that whenever you get a small or a strong bull trend day, the next day there is a 50% chance that you get follow through buying on the open, so some sort of follow through buying on the open. A 75% chance that we're going to get 2 hours of sideways to down trading starting by the end of the second hour, and only really a 25% chance of a big follow through bar tomorrow. So pretty unlikely that we're going to get a huge follow through bar tomorrow. For stop orders, I thought the first pretty reasonable one was 9, but hard to do. 14 is by the close, but you're really high up. You're betting on a bull trend day, which is what you got, but I think difficult to take. 19 is fine, but I think a lot of the same problems up here as I do buying up here, but still fine. 21, still by the close, still always in long, bull bar closing near its high, always in long, bull bar closing near its high, always in long, bull bar closing near its high. So that's a better way to think about it, especially on a trend day. 35 is credible, 37, 40, and then 48, one of the better trades of the day. Just buy it. 49, 50, buy the close bars. 52, 53, 54 potentially. And then 58 if you get trapped out, especially if you know what's going on and you know where we're trying to get to. You get trapped out below 57. A lot of traders will look to just buy above 58, try to make a 5-point scalp, which was, if you look at what was it was 58.25. So and if you bought above 58, if you bought above bar 58, you needed the market to get to 32.58 in order to make a 5-point scalp, and the all-time high was 32.58.25. So you can see the market is creating magnets based on the logic of traders and trying to trap traders out. Again, 46.57, and traders have to keep chasing the market up. And you can buy above 60 as well. I don't really trade limit orders, but I actually tried to buy below 39 today and did not get filled. So I thought that was a pretty reasonable one. I might start trying to give, what I thought the best limit order trade of the day was, something like that. But I don't, I don't do that. So I don't think about it all that much. Probably buyers below 55 for at least a scalp. Probably buyers below 50, again, for a second leg up from 48, 49, 50. On the daily chart, this is the breakout to the new all-time high, but I'm not really sure how much higher we're going. Maybe we get, some sort of 1, 2, 3 somewhere up here, but I would be kind of surprised if we end up just getting some, this continuous rally. We're in a bull trend right now, so the market's probably going higher, but I'm not sure. I'm not super convinced the breakout above this bar is going to be successful. So I think tomorrow will be a really telling bar. If we get follow through like we got here, so you get this bar here, we might have to get some sort of measured move up. This is a really strong bar for the bulls. It just looks like it's in a climactic area, and it could be a one pullback second leg trap. So you have to be aware of that. This, it's not super high. If you buy above here, you're going to make money, but you might have to sit through a pullback first. And again, I still think this whole thing might end up being a trading range. Yeah, and in the weekly chart, you can see we're getting a breakout. This is part of the problem. We're getting a breakout above a high one that was a bear bar. So I'm not really sure that we're going to go that much higher above the bear bar. And this is not a pullback in a bull trend. This is a leg in a trading range. So that makes me think this is a leg in a trading range as well. All right, that's today.